Hi folks, and welcome to lecture module 11.4 where we're going to speak about dividend transactions. And when we look at dividends, dividends are how we actually distribute earnings of a corporation out to its different shareholders. Most commonly these are distributed to shareholders via cash, but we may also share some of these earnings through stock dividends or stock splits. So let's talk about these different dividend transactions and how they impact our overall view. So cash dividends occur when we have sort of enough cash that's been reinvested inside of our organization that we can actually start to distribute some of it back to our investors or our shareholders. So in order to do this, we have to have a formal declaration by the board of directors. When our board of directors votes to distribute a cash dividend, there are three important things. The first is a declaration date. So that's the date that the board of directors actually goes out to the public and says, we are going to distribute a dividend on shares. Typically that declaration date will state the amount of dividends per share to be distributed. It'll tell us the record date. It will tell us when we'll sort of look at the ownership of our shares and who will actually get that dividend, and it'll also outline our payment date. So those three key dates will come out of our board of directors declaration. So in the declaration, again, we'll set out how much we're going to be paying. The record date is the date that we sort of declare ownership of the shares. So whoever owns the shares on a record date is who's going to receive the dividend. And then our payment date, so the actual date that we're going to send out the money. And each of those three dates has a specific sort of transaction that needs to occur. For example here, the declaration date again is the date that the board of directors authorizes and declares that we're going to pay a dividend. We now have a legal binding obligation to pay that dividend. As soon as it's authorized, we need to set up a liability called dividends payable. Okay? So for example, if we had a declaration on December the 1st of 50 cents per share on 100,000 shares, that means we're going to pay out $50,000 of our retained earnings out in dividends. And so we're going to recognize our cash dividends of $50,000. We're not going to pay them out just yet. We're going to pay them out on our payment date. And so for now, we're just going to set up our legal obligation, which is our dividends payable. On the record date, that's really just the date that ownership is recognized for the dividend purposes. So on our side, inside the company, there's no entry required on a record date. This is just the date that we figure out exactly where we're going to mail our dividend checks out to. Whose name is going to appear on those checks. On the payment date, we're actually going to send out our dividends, and so we'll record our cash out as a credit to cash, and we'll remove our obligation in dividends payable. So those three transactions occur anytime we create a cash dividend. And again, those three important dates to sort of recognize are declaration date, where we set up the obligation, our record date, which is the date that we understand who's actually going to receive the dividends, so who owns the shares on that date, no record required inside of the company, and then our payment date, the actual date that we're going to send the checks out, when we remove our legal obligation of dividends payable and pay out our cash. The next type of dividend is what we call a stock dividend. And so stock dividends are basically paid in shares. So we take the fair market value of our shares, and instead of getting a check for cash, shareholders will receive more shares of our organization. And so a stock dividend, again, it gives our shareholders a sense that they're being compensated for their investment. But it doesn't require us to pay out our cash inside of the company. So we can use our capital for something else or other purposes and still satisfy our investors. It can increase the marketability of the shares because now we have more shares outstanding, and typically based on supply and demand. If we have more shares, our market price per share should decrease. And it'll also restrict a portion of our shareholders' equity. So again, we can sort of create, we can pay out some of our retained earnings in this form instead of paying it out in cash. So in a stock dividend, we have to find the market price on the date of our dividend declaration. So in this case, let's assume we have 50,000 common shares with a balance of 500,000 in common shares accounts and 300,000 in retained earnings. All right. So let's assume that we did a 10% stock dividend. So what we said is we're going to pay 10% of our outstanding shares in a stock dividend. So we're going to take our total number of shares outstanding, the 50,000, multiply it by 10%, which means that we're going to give out 5,000 additional shares as a stock dividend. Now the market price on the date of declaration, as you'll see on the bottom, was $15. So that's the amount that we're going to sort of show as our dividend paying out. So on our stock dividends account, we're going to debit $75,000, and we're going to establish our dividend payable. On our declaration date, you'll see here we have a separate account treated very, very similarly to other dividends, but we're going to classify it as a stock dividend. And we're going to call it Common Stock Dividends Distributable. It's a long name. But again, this is the date that we set up our obligation. So we say we're going to pay out 10% of our current common shares out as a stock dividend. We'll go out on the open market and find the current price, and we'll distribute those stocks. So stock price of $15 times 5,000 shares outstanding in our dividend would give us 75,000 amount. Again, our record date is the same, no entry. And when we actually distribute, we're going to remove our liability of stock dividend distributable, and we're going to increase our common shares by the 75,000. So what we've really done is move funds from our retained earnings into our common share. So our overall shareholders' equity has been unchanged. We've used some of our earnings to issue new shares to our current investors. Okay, so we have a decrease in retained earnings. We've increased our common shares, and our total shareholders' equity remains the same. So you'll see what we've done before the stock dividend. We had the following information. After the stock dividend, we've added 75,000 to our common stock, and we've subtracted 75,000 from our retained earnings. And our number of shares has gone up. We've issued another 5,000 shares, and so on we have 55,000 shares outstanding. The last type of dividend is what we call a stock split. The stock split basically leaves individuals again with an ability to have more ownership as a number of stocks, and we issue new stocks based on how many shares they currently hold. So stock split has no effect on total share capital, retained earnings, or shareholders' equity. The only thing that it impacts is the number of shares outstanding, which typically tells us that, again, our market value of the shares will decrease proportionally to the split. So let's take a look. If we say we're going to have a 10% stock split, now we're going to, again, have 50,000 additional stocks. What will basically happen is, sorry, this is a one-for-one stock split. So if you have one share currently, you're going to receive another share from the company, and so our overall outstanding shares will increase, but you'll note that nothing else increases at all. And there's no entries required for a stock split. Right. So again, our stock splits are basically just issuing additional shares to our current shareholders. In essence, reducing the market value per share and giving folks a larger proportional, a larger number of shares that they hold. All right, so that's our stock, our dividend transactions. Again, understanding how each of them affects our different elements. So we look at a cash dividend. We pay out our cash. So assets are going down and retained earnings are going down. We're taking funds out of our retained earnings and paying them directly into the pockets of our shareholders through a dividend. A stock dividend, we're taking our retained earnings and we're paying them out in new shares. So again, we have new shares outstanding and we reduced our retained earnings. So our overall number of shares has gone up. And in the stock split, we have no impact on any of our accounts, but we've increased the number of shares that are outstanding by giving our current investors additional stocks in exchange for what they currently hold. All these ways are how we share our earnings with shareholders or add value to them by decreasing market value and giving them additional shares to participate in future growth of our organization. So thanks so much. That was lecture 11.4, dividend transactions. Take care.